We begin, as always, with three things investors ought to be thinking about right now. Stocks retreated after Fed officials signaled interest rates could stay higher for longer. The market is cautious ahead of next week's key inflation report. BP is scaling back its green ambitions after raking in record profits in 2022, what it could mean for investors. And it was a week of wild moves for Disney, embattled fintech Affirm and Bed Bath & Beyond. Why one of those might be a good investment. On the Barron's Roundtable, my colleagues Ben Levisohn, Carleton English, and Jack Hough. So, Ben, after a really strong start to the year, the market took a breather. I guess it had to happen one of these weeks.
Yeah, it really did, and it finally did. This was the biggest loss for the S&P 500 of the year. It was down around 1%-ish or so. But there wasn't really anything to cause it to happen. In fact, it might have been the lack of stuff. Some people have ascribed the rally to the data that we've had that was comforting on inflation. Maybe it's slowing down. The job market's still strong. Maybe there's no recession. So maybe there's no landing. And this week we didn't have any of that economic data that was important, really. And so it created this vacuum that the market kind of fell into. You also had some technical issues, with the market bumping up on some resistance and some earnings that weren't so hot.
By no landing, you mean that's even better than a soft landing. It doesn't land at all.
That's right.
That's macro. Let's talk about the more specific stuff, which was earnings. On the one hand, most companies are beating earnings expectations, but we all know what happens. Analysts lower the bar until it can be cleared. They're not clearing it by as much as usual, and that has the market a little spooked.
Yeah, they're barely clearing the bar at this point, and it does look like we're going to get an earnings decline year over year for the first time since 2020, and that's that's a problem for, it's earnings and valuations that really push markets up. And if earnings are going down, it's hard for the market to keep going higher. So it's something to really keep an eye on, especially because expectations for earnings for this year are also going down, and that could really signal an earnings recession.
Alrighty, so an old market superstition says you should be rooting for the Eagles in the Super Bowl. When the NFC wins, the market does better. I think maybe for our purposes, we'd rather look at the Fed.
Yeah, I think we need to. The market for a long time has been ignoring the Fed, even though we keep getting these governors coming out. John Williams, I think it was this week, who came out and said the rates could stay high for 2 years after just to make sure inflation comes down. And the market seems to be starting to get that. We've had 2-year yields rise up a little bit. They're at some resistance now, but if they keep going up, that could be a pretty big problem for the market. The next thing to watch is going to be the CPI reading on Tuesday. Another soft reading. Maybe the market takes off running again, but if it's hot again, all bets are off.
Alrighty, let's go back to those earnings. Jack, what caught your eye in specific companies this past?
Start with Bed Bath & Beyond. That was said to be near bankruptcy. They got a financing lifeline from Hudson Bay Capital, but that financing will be dilutive to shareholders. And the stock was all over the place. Ben, just act out these dramatic turns for me by changing your facial expressions, if you would. The stock was up 92% on Monday, then down 48% on Tuesday, down another 14% Wednesday, another big decline on Friday. Don't get too frowny now. I don't want you to pull a brow muscle. Financing or not, they haven't solved the main problem, which is that people don't want to buy the stuff that they're selling in large quantities where they're selling it at the prices they're charging. That's pretty significant. Affirm Holdings, that's the buy now, pay later company, that plunged 17% on Thursday. This is not a buy now, pay never issue. The credit trends are okay. It's just that rising rates are making shoppers reluctant to spend on credit. It's almost like sensible, it seems. That company's laying off, cutting costs. Lyft plummeted 36% on Friday. Unexpected loss. Wedbush downgraded the stock. They said this is starting to look like a winner-take-all market. Guess who's not the winner? Lyft is not the winner.
Uber is.
The winner is Uber. And Disney, I'm going to include Disney because it had a big gain on Thursday, didn't hold on to it. Bob Iger's back in charge, and he announced massive cost cuts, layoffs, could make streaming profitable sooner than people thought. There's also a creative restructuring. I'll call it a reverse Chapek. It's stripping out the things that happen there. Show business executives will have more control over distribution. Nelson Peltz is declaring victory. I think it's too early to call this a successful Iger turnaround. If I can sum it up with a quote from She-Hulk attorney at law, being a superhero is all trial by fire. That's right from the trailer.
Fair enough.
The magic's not definitely back, but it may be back. Carleton, real quick, BP has discovered, wow, it's really profitable to sell oil.
Yeah, imagine. So the company is trying to thread this needle where it wants to continue investing in renewable energy, but obviously energy companies now, massive profits this year. You can't dial back too much on it. So it's kind of extending its timeline on that. Wall Street likes the idea because what the BP CEO told us this week is you kind of had to measure energy security with affordability today. So while oil and gas continues to be profitable, yes, you do need to think about the future of renewables, but for the needs of households today, we got to keep energy affordable.
Beyond petroleum, yes, but maybe not until next year.